In this video, I interview Rick Rule. Rick Rule is one of the most legendary natural resource and commodities, gold, silver investors in the entire world. And so in this interview, we discuss gold, we discuss silver, we talk about Warren Buffett buying gold stocks, we discuss where he believes the gold and silver market is heading, other investments outside of that sector that he is keeping an eye on, and his entire plan for when he is deciding to leave the gold and silver industry. And he ends by giving 4 tips that every single person should be considering if they not only want to preserve their wealth, but they want to continue to grow their wealth. So if you enjoyed this video, please make sure you hit the like button on this side and this side. That sends us out into the YouTube algorithm so more people see it. Leave a comment down below and let me know what you think of this video. Rick also makes an offer at the end where he, for free, will review your portfolio. All you have to do is submit through the form on the website down below. He talks more about that at the end, but I'll put the website link where you can submit your natural resource portfolio to Rick. That'll be in the description. So be sure you hit the like button right over there and right over there. And let's hear from one of the most legendary natural resource investors in the entire world on the things he's looking out in the markets right now. Okay, today we have Rick Rule with us. I just had an interview with Ross Beatty, who formated all of the Pan American Silver and has had some incredible successes. And I asked him a question at the very beginning, and he said, you know, I am not in a position to answer that question. I think the most intelligent investor that I've ever had the privilege to meet is Rick Rule, and I think that would be a better question for Rick Rule. So it's an honor to have you back on, and seems like everyone says the same thing about you, Rick.
Well, certainly a pleasure to be with you. And I'd like to acknowledge that one of the reasons I have a reputation as a good investor is because of the efforts of very high quality entrepreneurs like Ross Beatty, who I've had the pleasure to back for 35 years. So the admiration society is mutual.
So just for everyone listening to, Rick just moved, just still moving into a house that's still under construction. So we might hear a little noise here and there, but it won't affect the wisdom Rick has for us. So let me ask you to begin with, Rick, how has your viewpoints on the silver and gold bull market or the formation of it, how has that changed, seeing how 2020 has played out between the coronavirus, the mine shutdowns, the money printing, the instability in United States politics? How, if any, has your view shifted?
I think several things need to be taken into account. First of all, the move in the gold price from $1,100 to $2,000 makes it arithmetically a little less attractive than it was because some of the opportunity has been priced in. Similarly, when we talked a few months ago and silver was at $14, it was just stupidly cheap. You know, I was able to say, you know, the chances that silver doesn't go up, given that gold has moved, the chances that silver doesn't go up are nil. At $28, I'm not as able to say that. I will tell you that I believe that the wind is still in precious metals sales. The wind is in precious metals sales for the same reason that it has been in the prior interviews that we have done. Gold moves up when people are concerned about the purchasing power of their savings denominated in fiat currencies. And they have many reasons to continue to be concerned. The first is, of course, quantitative easing. If Jake Ducey did quantitative easing, it would be called counterfeiting, and he would be put in jail. When Congress does it, it's called policy, and they get reelected. The second is related, debt and deficits. The debt that societies around the world, not just the United States, have, are unserviceable. They are simply unserviceable. And artificially low interest rates, which allows them to pretend to service the debt, does 2 things. It penalizes savers by removing the risk premium by way of interest, and it artificially subsidizes consumers of capital, ironically, like miners. Which is useful. And I think the third thing that needs to be taken into account is the extraordinarily low market share that precious metals and precious metals related investments enjoy relative to other asset classes. We've said this on your show before, but precious metals and precious metals related investments comprise between 1/3 and 1/2 of 1% of total investment and savings assets in the United States.
Wow.
The 3-decade mean is between 1.5% and 2%.
Wow.
So it doesn't take some dramatic gold bug environment like a gold standard or the collapse of the US economy or any of that stuff in order for this to work. The only thing that has to happen is that the market share has to revert to the 3-decade long mean between 1.5% and 2%. If that happens, demand for precious metals and precious metals related assets triples or quadruples in the largest savings and investment market in the world. Now, what I tell people, and I think I told you earlier, particularly younger people like you, where you are involved in your first rodeo with precious metals, is that there will come a time when you have to sell. And I've been thinking in response to many questions from many people, yourself included, what will be the signs? I would say that real interest rates, positive real interest rates, in US dollars will be the first thing. When the interest yield on the US 10-year Treasury offers 200 or 250 basis point yields in excess of the consumer price index, which is a measurement of the depreciation of the dollar. Right now, CPI increases, the CPI is estimated to be at about 1.6%. I believe that's an underestimate.
Yeah.
But if you have a 50 basis point yield in the US 10-year Treasury, what it means is that the biggest competitor for gold in terms of safe haven savings assets costs you over 1% a year, compounded. Jim Grant calls that return-free risk. If you saw the yield on the US 10-year Treasury at 4.5%, with the underlying inflation rate down at 1.5 or 2, you would need to be concerned about the gold stocks because you would have disintermediation out of gold back into bonds. I don't see that happening anytime soon. The second thing that I think that you need to look at is market share. When you begin to see the asset class popular enough that it comprises, say, 3% of savings and investment products in the United States, then the easy money will have been made. It could be that the big money follows. In other words, it could be that there's a fad associated with gold. But the easy money is between 1/2 of 1% market share and 2% market share in terms of savings and investment assets in the United States. So in terms of when to sell, I think there are two quantitative gauges. The first would be real interest rates in the US 10-year Treasury. And the second would be market share of precious metals and precious metals related assets in the whole savings and investment matrix available in the United States.
So the second one's pretty self-explanatory there on the market cap, but first one, do you see that really happening? I mean, it's just, yeah, do you see that really happening?
What I've learned is that I'm a credit analyst, not an economist. I don't see it happening. I mean, I don't really see sanity returning to credit markets as long as people can vote against it. Remember that an artificially low interest rate is a function of spenders confiscating wealth from savers. And that happens in a democracy because spenders are more numerous than savers. We talked earlier on your show, I think, about the libertarian definition of an election, which is 4 coyotes and a lamb voting on the lunch menu. In this circumstances, the savers being the lamb, and of course the spenders being the coyotes. So when you ask politically or socially, do I see a return to fiscal sanity? No. But stranger things have happened. And I think if you are asking yourself what could derail the precious metals market, the two most important things are positive real interest rates and market saturation.
So on looking back at, for instance, when you do your speech on the Barron Gold Index and it shows, you know, the incredible volatility and it's an amazing thing to watch, but it seems like whenever there's a gold rally, it goes through the roof and then it quickly goes back through the floor. Do you think that there'll be as much volatility to the downside this time when the rally ends because of the amount of money printing, or do you think that it'll be less volatile on a sell-off because it's such a different economic condition than it was before?
Neither. I think when you review the Barron's Gold Mining Index, and I would encourage all of your listeners to review it just as a visual aid to the markets, it's important to segregate, first of all, between secular bull markets in gold and recoveries from oversold bottoms. When you look at that chart, you see both phenomenon very well. You see the gold equities bull market of the 1970s, beginning in 1970 and peaking in 1981, a truly astonishing bull market. You see a very separate bull market beginning in 2000 and peaking, depending on your point of view, in either 2008 or 2011, also an important bull market. You see contained in those two bull markets and the ensuing bear markets 8 recoveries from oversold bottoms, much shorter phenomenon. The recoveries from oversold bottoms exhibit exactly what you described. Base building, a J curve, and then the back of the hockey stick graph, which is just as steep as the front, but a lot less fun. What you see in secular bull markets, and by the way, I think we're in our third secular bull market.
Okay.
I think what we're seeing now is very similar to the bull market that we saw in the beginning in the year 2000. But what you see when you examine the charts, either of the bull markets or the recoveries from oversold bottoms, is that gold is astonishingly volatile. You can have cyclical declines in secular bull markets that take 50% off the index. That's volatility. In recoveries from oversold bottoms, you can see several 15 or 20% declines, cyclical declines in secular markets. And so investors who aren't both financially and psychologically prepared to stay the trade need to be very, very, very cautious. And as I say, you also have to have a plan yourself, which you review, but you stick to, that tells you when you're going to begin to exit the trade. Because the backside of these markets is ugly. When you come off a gold bull market, let's assume that you have a 10-year long bull. Not disinclined to believe that we'll have this year, this time. But when you come off these markets, traditionally you have 10 years of, shall we say, softness. And it's important that you manage to keep most of the gain that you enjoy in the bull market and look for something else that's unpopular. And as I say, for me, what I do in terms of that is I try to be quantitative. So I would look at real interest rates and I would look at the market share of the material. It doesn't mean that if the market share of precious metals got up to 3%, that I would sell all of my gold positions. It just means that I would begin to be much more cautious than I'm being now.
Understood. So then let me ask you, when I asked Ross Beatty similar type of question, we were discussing how he sees the rest of the market playing out. What inning do you think that we're in?
I think in conventional circumstance that we're probably in the third or fourth inning, but I think this one goes extra innings. Because the reason I think it goes extra innings is really twofold. I think we have less savings and resilience in our society than we had in the decade of the 90s or than we had in the decade of the 60s. So I think that the policy responses to the circumstance that we're in are going to be less effective than they were now. And I think that the demand for policy response is going to be higher. In other words, I think that the politicians' ability to do the right thing, not that they're ever really tempted to do that, but their ability to do the right thing is going to be constrained by sociology. And the consequence of that is that I think that we are doomed, if you will, to higher precious metals and higher precious metals equities prices. I think it's useful to note too, Jake, that ironically, these policy responses are good for gold miners two ways. By artificially lowering the interest rate, they artificially lower the cost of capital, which is the biggest single expense in a capital-intensive industry. In other words, they make money cheap for money consumers. The economic softness that we're experiencing worldwide means that the price of inputs, the price of consumables in the mining industry, particularly energy, but also tires, cement, steel, capital equipment, is constrained. And if you produce gold outside the United States, where currencies are depreciating even more rapidly than the dollar, it means that your input costs are denominated in currencies that are depreciating while you sell your product in a currency that is relatively stable, which is to say that your margin increases every single quarter. A circumstance where the policy response is good for the product that you produce, while at the same time lowering the costs of production, is certainly the best policy environment I've ever seen for gold. Not, of course, that they did that deliberately.
Yeah, that sounds like a good business to get in. One of those types sound pretty good to me. So then let me ask you, do you ever throw around numbers in your head? I know you're such a rational guy that you would never come on and you'd be like, it's going to this price. But do you sit in your head, whereas before, maybe if I asked you this 5 years ago, you would say, I think gold can eclipse its top high. Obviously, it's already done that now. But I mean, how much room do you think we have to move? I mean, do you think when people say 4,000, 5,000 gold, do you think that's ridiculous? Do you think that we're nowhere in that?
Understand that the gold price in most people's mind is denominated in a floating abstraction, the dollar. So you need to ask yourself, how low can the dollar go? I don't think of it in that context.
Okay.
I think of it in something that I can wrap my head around, which is to say a positive real yield.
Okay.
And market share. I mean, if you ask me...
So those are the only two ways you look at it, is through...
If you give a good salesman like me, or you, the use of the word could or should, I can make you buy anything. And I don't want to trick myself in that same fashion. Philosophically, as you might have gathered, I'm fairly libertarian, and as a consequence of that, I'm a gold bug. But I don't want to consider my own prejudices to be an investment consideration. I would rather constrain myself with arithmetic and consign my opinion the value that it's due, which is to say nothing.
You're good at that. So let me ask you, first person I thought of when I saw that Warren Buffett finally bought some gold stocks was you. You've told me when we got to know each other a lot better, I think you told me one of the very first things that you bought with some of your first natural resources profits is you went and bought Berkshire Hathaway a really long time ago. And I know you really admire his approach to value investing. You're the one that told me to buy Benjamin Graham's books. What did you think when you saw that?
It's a very important development, but not for the reason people think. People think that Buffett's purchase of Barrick had to do with the shifting of his opinion with regards to gold. And I don't think that's what it represents at all. What it represents is something much more profound, which is to say that one of the biggest gold mining companies in the world is cheap, even if you don't believe in the project, in the product that it produces. Buffett has described gold as a pet rock. And I don't think that his view of gold as an inert, non-income earning asset has changed. I think what he looked at, or maybe what one of the underlings in his firm looked at, because remember, his bet on Barrick, while it was big for Barrick, was a rounding error for Buffett.
Yeah.
But what happened is their methodology looks at the price you pay for an income stream. The price you pay is enterprise value, which is market capitalization minus debt plus cash. That's the price that you would pay if you bought the whole business at today's share price.
Okay.
And they look at that enterprise value relative to the ability to generate free cash at whatever discount you tend to want to apply at the interest rate over, say, 10 years or 12 years. What they concluded was that Barrick, as an example, was cheaper than Coca-Cola, a company that they already know that they could buy more of. And
Hmm.
that's important. What it says is that if you don't have an agnostic view over the commodity price, which he does, that the gold price, that the gold share, at least Barrick, is from his point of view cheap relative to its ability to generate competitive rates of return at today's gold price. And I think that's very, very, very important. Now, Buffett did say some things about the broad economy that are worth our considering too. He said that it didn't occur to him anytime in the last 30 years that you could have a negative real interest rate environment. He said that he didn't foresee a circumstance where the political and social forces in the economy could so dominate investor psychology and markets itself that you had an artificial cost of capital. Buffett has spent 40 years of his career generating float, which is to say, in the insurance business, premiums collected before policies paid. This is money that sits on the balance sheet, but it isn't debt because you don't owe it, and it isn't equity. And that float in Berkshire Hathaway, $120 billion, is worth a lot in a real interest rate environment. If you're getting a 3% return on capital employed, that's neither debt nor equity, your return on equity is much, much, much higher because you're getting a 3% return on capital that isn't equity. What Buffett points out is that in a negative interest rate environment, that float can have a negative net present value depending on how you allocate it. So he's trapped in this low interest rate environment into having to buy equities because he can't buy debt. He can't put himself in a circumstance where the yield on his float is negative because ultimately he'll have to pay that float out in policy. So what he did say, which gives me great comfort, by the way, because I think he's a brilliant guy, is that the current interest rate environment and the current policy environment with regards to debt and deficits is artificial. George Soros famously said that he became a billionaire not by working hard, but rather by finding broadly held premises that were wrong and betting against them. And I think the broadly held premise that we cling to in this environment is that the policymakers are competent and benign, and that negative real interest rates are a force of nature that can go on for some period of time. And I think that one of the ways that you bet against that falsely held premise is certainly gold. From the point of view of younger investors like yourself, you need to think about gold in a very different sense. The deficits that we're running now and the debt that we're incurring is a transfer of wealth and living standards from people to people of my age, from people your age. We are spending beyond our means to subsidize older people who are no longer as productive a member of society. We're financing that by debasing the currency and by adding recourse and non-recourse liabilities that your generation has to pay for. Thank you, first of all. I'm delighted that you're subsidizing my dotage, although in fairness, I've saved enough that I can afford my own dotage. But I think it's important that young people need to understand that the social construct as it exists today is an income and wealth and living standard transfer from young people to old people. And there are very few ways that young people have to protect themselves in this circumstance. The first is to save. Many young people want to live rich as opposed to be rich. And you can't be a capitalist if you don't have capital. So you have to save. And some of that capital has to be deployed defensively in an asset which isn't simultaneously somebody else's liability, and in an asset that represents a bet against a widely held premise that is wrong, which is a way of saying save and put some of your savings in precious metals and precious metals related assets, particularly for younger people.
Interesting. So, they say a lot about Buffett that he buys something and he holds it for a long time. He doesn't buy something and sell it in 6 months. So what does that make you think as it pertains to him buying Barrick and where gold could go? Has it made you think about that?
Remember this. That's not what Buffett says. What Buffett says is that you make money holding for the long term, but you also reassess your decisions and sell your mistakes ruthlessly. Twice in his career, he's been attracted to the potential operating leverage in airline stocks. And twice in his career, he's lost billions, but sold quickly. What he says is that you make money by sticking with your successful bets. Buffett is disinclined towards capital-intensive cyclical businesses, and capital-intensive and cyclical defines Barrick. And my suspicion is that even 10 years from now, he will not be a Barrick holder. He will look for other companies where the enterprise value relative to the free cash generation is cheap. And he will see a circumstance in Barrick, if I'm right, where the Barrick price goes up at the same time that its future becomes less attractive, and he will sell it. I only wish that your listeners and readers and my clients would display the same wisdom.
So is this kind of the example of the advice that you give me of keeping an eye out as the market's continuing to go for new places to put the money that are presently less attractive to most people but present a future opportunity?
Yeah, Jake, you have to do that. You absolutely positively have to do that because markets are really pernicious psychologically. As the gold price goes up and the price of precious metal shares go up, in other words, as they become arithmetically less attractive because you're paying more for the opportunity, the fact that you have been right and the fact that they have performed well means that the price performance justifies the narrative, and the narrative becomes more valuable to you as a consequence of the price performance at the same time that the investment is becoming arithmetically less attractive. When, let's say that you buy something for $10 a share, and let's say that nothing changes in the company, it goes to $20 a share. Arithmetically, the company is half as attractive, but you like it 4 times as much. The fact that it doubled in price makes you feel good about yourself, which you like, and the price action justifies the narrative that you employed to buy the stock. So it's important that you continue to reevaluate your premise and you continue to look for opportunities to deploy capital that are as seemingly unattractive in the present as the opportunities that you're selling were at the time that you acquired them. You had the good sense and the good fortune to acquire precious metals and precious metal stocks when they were hated, when most people your age couldn't spell gold, despite the fact that it was a foreign word. At some point in time, the fact that you were able to do that is going to benefit your reputation to the extent, pardon me, that you will be revered, and you will enjoy being revered. It's at that point in time when you are going to need to forward shift some of your investments and forward shift your reputation to areas where your viewers are either bored or terrified.
So what do you think some of those areas are right now when you're kind of contemplating?
Well, looking forward, and I'm not encouraging your people to pay attention to this now because they're economically sensitive. I think oil and gas will continue soft and then will explode to the upside, Greta notwithstanding. I hate to use the word explode in the same context as uranium, but I think that
I'll say it for you.
I think that the uranium price 3 years from now, 4 years from now, 5 years from now, at some point in time, will be dramatically higher. And the price of uranium stocks will go to the upside, notwithstanding the fact that they may do nothing for 18 to 20 months. Copper is in deficit. I don't expect the copper price to go up because I expect the economy to be weak for another 2 or 3 years.
Okay.
But with the copper price being weak for 2 or 3 years, what you do is you limit sustaining capital investment, which means that you limit productive capability. And when the economy begins to recover over its own volition, copper fuels the economy. And the copper price, I mean, it wouldn't surprise me at all to see $4.50, $5 copper in constant dollars, not in depreciated dollars. I don't see that happening for 2 or 3 years. But I see the ability now for some investors to buy the highest quality industrial materials companies in the world, tiptoe into them. But if you saw a circumstance where we had a broad general market decline, where the S&P 500 fell 35, 40, 50%, I think that you could buy the biggest and the best broadly diversified natural resources companies in the world with complete impunity if you have a 5-year view. I mean, complete impunity. And my suspicion is if you were able to buy them at 30 or 40% below today's price, 5 years from now, 6 years from now, 7 years from now, you would be sitting on 400 or 500% gains. It wouldn't surprise me if you bought them 30% lower to suffer a 20% loss on top of that before you enjoyed those gains. But the truth is that doesn't matter much. Ultimately, we discussed Ross Beatty in glowing terms, and I'll use him to illustrate this point. I have been successful investing with Ross Beatty. I believe I've had 14 starts with Ross. That is to say, wow. Companies that he's been around 14 times in 35 years. I've suffered an absolute loss once, which is pretty good. 13 out of 14 were wins. Probably more importantly, 6, 7, 8 of those wins were 10-baggers, which is to say that the share price of the company escalated tenfold during the period I held it. I don't want to mislead your viewers. I didn't hold all of my stock for that whole period of time. I trimmed along the way. But the truth is that the market gave me tenfold returns or 20-fold returns. What's important in this discussion, however, is that I don't think in any of the companies that I enjoyed tenfold returns that I didn't experience a 30 to 50% share price decline during the period of time that I held them. So it's important that you understand why you own a stock, not merely its price, but rather why you own it, what could go right and what could go wrong. You have to have the financial and psychological ability to stay the trade in order to enjoy those tenfold returns. Yeah, so in the context of the biggest and best natural resource companies, if you buy them in a broad general market decline, 30% below where they sell for today, you may experience further price weakness. You need to, in this game, play it 5 or 6 years at a stretch, which I realize in your 20s is a real leap.
Yeah, it's less of a leap because you've done such a good job of explaining your career and really understanding where you are today, is because when you were in your 20s, you had this broad view. What about like nickel and cobalt?
Nickel could be softer in the near term. But I think demand for, as an example, stainless steel will only increase. And nickel's quite rare, ultimately. So I think over 5 years, nickel's strongly higher. I don't see any way in the world that cobalt won't do well. You may hurt yourself owning cobalt stocks in the sense that cobalt is produced really only 2 places, Congo and Russia, which means on the supply side of Congo, if you're going to be competitive, you have to be in one society that's a wreck, which is to say Congo, and the other, which is at the very best sort of obscure, which is Russia.
But what about cobalt? Doesn't Jervois have that huge cobalt deposit in Idaho?
Well, I wouldn't describe it as a huge deposit.
Okay.
I wouldn't describe it even as a competitive deposit.
Okay.
What Jervois is trying to do is put together cobalt resources that are marginal at today's prices, that could be economic at higher prices, and they're trying to lower their cost of capital by owning cobalt in jurisdictions that aren't competitive, but are perceived to be safe.
Got it. Understood. So when you say all those areas kind of in conclusion, and I know you got to run, in conclusion, when you say you were talking about the exciting prospects of gold and all these types of things, and then you say keeping a lookout for these other areas, are you actively putting positions in all those types of areas you discussed, from copper to natural gas to oil to all those things that you were saying? Or are you keeping your eye out on uranium, Are you totally positioned, or are you anticipating there's still quite some time out and you're keeping your eye open?
I have, relative to where I'd like to end up, about a 15% position.
Oh, wow. So you have a lot of buy-in to do.
Other materials. I believe that the disconnect between equities markets, that is to say Wall Street and Main Street, is too broad to go on. And I don't see a circumstance where Main Street recovers well. So I think Wall Street declines. It doesn't mean that it'll happen. And so I am sort of the belief that we are going to have at least a brief period of softer, perhaps much softer equities prices. And that I'll have the ability to fill out my positions during periods of panic, similar to the period of panic that we had in March this year or in 2008. I also think that I'm allowed to be leisurely in my pursuit of those bargains because those materials are economically sensitive. And I don't see any natural economic recovery occurring for 2 or 3 or 4 years. As a consequence, both of the unwinding of the artificial recovery, the 2009 to 2019 recovery, and also as a consequence of the economic dislocation that was forced on us by the COVID-19 virus. I think that I can afford not to be aggressive, adding to my position in commodities, because I think that I'll have the opportunity to participate in those commodities at a lower price. And I think that my fear of losing it, missing it to the upside, is constrained because I personally believe that the global economy is going to be fairly weak for 2 or 3 years, maybe longer.
Got it. So you think that your opinion is that we're going to retest those March lows or lower once things kind of...
I'm smart enough or dumb enough not to put a number on it. I just don't believe that the recovery that we're experiencing in financial markets is mirrored by a recovery in the economy. And I see that valuation gap probably being addressed by declining financial markets rather than improving private economies. I also think that we're going to see a lot of volatility in the next 18 months, partially due to the conflicting forces of artificially low cost of capital, that is, artificially low interest rates in a soft economy. Artificially low interest rates are extraordinarily bullish. Buffett is forced to invest 120 billion in equities that he would rather have in bonds, as an example. And I think that the volatility that exists as a consequence of those two forces bumping into each other will unnerve people who haven't suffered through periods of volatility before. And I think that could be a cause of softness in equities markets.
So what's your advice to someone like me that, is aggressively wanting to have the success and seize the opportunity right now in the bottoms of commodities for so long in the environment right now? If you and I were just sitting in your office and I say, all right, Rick, I've done so well, and you know more about my business and my stand and where I'm at in my life. What's your advice to someone like me right now in conclusion? What are
3 pieces of advice, maybe 4. The first is continue to invest in your basic business. There's no way in the world that I can make you as much money as you can make you. So never let your basic business be undercapitalized. In fact, always keep it overcapitalized so that you can take advantage of opportunities. The second is save and stay liquid. Save 10% pre-tax of every piece of income you get. You don't get to have a nicer car. You don't get to have a Starbucks coffee. You don't get to drink a beer. Nothing until you save 10% pre-tax. That's a cost that comes off the top. And keep some of it in cash, even though the return on cash is negative. I've learned in my career that being liquid gives me the tool, which is to say the cash, but also the courage to take advantage of broad sell-offs rather than being taken advantage of. Most of the money that I have made in my career has happened as a consequence of a relatively few number of decisions that I took at the right time. Buying things like Pan American when they were selling off very, very, very broadly, having a shopping list of assets that I would like to buy, and the willingness to buy them when all of my competitors were scared to death. Those are the most important things. The last most important thing is to, as Wayne Gretzky would say, skate to where you think the puck is going to go, not to where the puck is. I don't know if you ever heard that analogy. For the younger viewers, Wayne Gretzky was a very famous hockey player, maybe the best of all times. He wasn't a big guy. He wasn't a mean guy. He wasn't a fast guy, but he was a smart guy. And he said, you know, on the hockey rink, there's all these big mean guys swinging sticks around the puck. It's not a good place to be. Where you want to be is where the puck is going to go, not where the puck is. And so while you are enjoying, and I think you'll continue to enjoy, the decision that you made when gold and silver was unpopular, you need to continue to ask yourself the question, what makes me uncomfortable now? What is unpopular now? What is a situation that is almost certain to improve, but one that people don't like because the price action, the narrative has been negative?
And then it's just understanding it enough where if it takes longer than you think to go up, you've understood it, so you're not worried about it.
It will. You know, it will. I've been saying that the uranium market needs 18 months to improve for 5 years.
That's funny. Well, thank you so much for your time. I sincerely appreciate it, and I don't want to hold you too much longer. So, thank you for your time, Rick.
If I could, I'd like to make my normal offer to your viewers, if that's
okay. Please.
I enjoy talking to your viewers, both young and old. I was surprised that not all your viewers are millennial. In fact, some of them are my age.
Quite a few.
Yeah, it's lovely. And so what I'd like to do to put the sort of lessons that I try to teach into practice is I would encourage your viewers and listeners to forward their natural resource portfolios to me. There's a web link, sprottusa.com/rankings. And there's a form there where if you enter your natural resource stocks, I personally will rank them 1 to 10, 1 being best, 10 being worst. And I'll comment on those stocks where I think my comments have value. In addition, I will return by email the Barron's Gold Mining Index, which I think is an absolutely invaluable visual tool to understand where we are in the gold equities markets from a historical point of view, and also an invaluable tool to look at the anatomy of bull markets and the anatomy of recoveries from oversold bottoms to see in real senses the volatility inherent in these markets. And in addition to that, I'll send a 100-year commodity chart, which will show you just how cheap commodities are relative to other asset classes, and where 3 years from now, 4 years from now, 5 years from now, whenever a commodity bull market gets started, where you could expect those commodity prices to go. I really believe, Jake, that there's a strong probability that resource investors are going to, in the next 5 years, enjoy 2 bull markets. A precious metals bull market, which I think we're into right now, followed by an industrial materials market. My suspicion is that the decade that we're in now will resemble, in terms of total return, the decade which was 2000 to 2010, which was certainly the finest financial event of my career.